Hi guys and welcome back to Trading and Investing with Carl. In today's video I'm going to give you a market update and outlook as we start into the next week. First of all, I wanted to say sorry to everyone who waited on the video. I've had a lot of things to do the past days, so I hope you can understand that. But now, let's start. The first thing we are going to talk about is the retail sales in the US and the Eurozone. Here on the chart you can see from JP Morgan, you've had a very strong recovery in the US markets, but not in the Euro markets. And this is because in the Eurozone you've had a lot of lockdowns and a lot of restrictions you didn't have in the US. This is definitely something that is going to affect the inflation in the US because a strong recovery means high demand for goods and an increasing of the velocity of money, and also is going to have an effect on the relation between the euro and the US zones in terms of economy. The next thing you see here is a chart based on Google retail and recreation and mobility data. You can see here the Eurozone is in the worst shape and Africa is in the best shape. This also has to do with the lockdowns and the restriction in the Eurozone, and also because Africa has a lot of experience with pandemics in the past and also had already built the infrastructure that is needed for a solid track and trace system. So that is also something that is going to affect the global economy, and is definitely something that is going to benefit Africa, North America, Asia and Pacific and the Middle East, the Arab states, and also Latin and South America, but they are a different kind of story. But the Eurozone is going to take the worst hit of them all. Next on, we are going to talk about the things Christine Lagarde said. For everyone who doesn't know who Christine Lagarde is, she is the chairwoman of the ECB. She said the ECB is going to extend the bond buying program, but I think the people at the ECB forgot, or maybe they wanted to forget, that it's not going to help the market. It is not going to solve the problem of inflation. It's not going to solve the problem in the US bond market. And if the US bond market has still rising rates, that would mean people in the Eurozone are going to rush out of Euro bonds and rush into bonds that are sold in the US, because they get a higher yield there, so that is just logical. Here you can see a thing that Sven Henrik said, and I think it nailed it. We injected so much liquidity, causing yields to rise faster than we expected, which threatens the viability of our risk-free rate valuation balloon. Hence, our best course of action is to add even more liquidity at a faster pace. Basically, he just wanted to say the thing that I also want to say is, it's not going to solve the problem of inflation. More liquidity in the market is going to cause a higher inflation, and so it's going to cause a higher yield in the bond market. So it's not the right way to try to push down the yields of the bond market, because sooner or later it won't help anymore. Here you can see a chart of the 10-year treasury yield. You can see here the rise of the yields are going higher and higher and higher. I thought we are going to see here where the arrow is some kind of consolidation, but we've broke through that resistance area like nothing. And this is also based on the end of the SLR program, but that is something I'm going to explain you later. And it's going to be interesting to see when the rise of the yields are going to stop. Here you also can see a chart from the 2-year, 5-year, 10-year and 30-year treasury yield. And you can see here we've got a strong rise in the 5, 10 and 30-year. And that is something that is going to affect the US dollar, because high yields means people are going into the bond market and into the US dollar, and that is going to affect the US dollar market. So the US dollar could, and in my opinion will be stronger if we see rising yields in the market. That is something you have to keep in mind if you trade against the US dollar, if you trade euro dollar, yen dollar, whatever. You should keep that in mind. It could affect your trading strategy. Here you can see a chart from Bank of America that shows that we've had the third worst treasury loss this year since 1973. This large drawdown means the price of the bond is going down. So for everyone who doesn't understand the bond market, if prices from the bond market are going down, that is causing the yields to go higher, because that means there is less demands in bonds, and if there is less demands, that means they have to offer a higher yield, so it creates more demand. Another thing I want to show you is that the US households are looking rich on the paper. So their net worth has grown in Q4 up 6.9 trillion US dollars. So that's 5.6%. But also you have to keep in mind the household debt increased at an annual rate of 6.5%, and that was the fastest in 13 years. The reason why I say they look rich on the paper, because the growth didn't happen on an economical base. It's based on the value of the equities they own, and the value of equities increased by nearly 4.9 trillion. In this chart you can see the equity market exposure, including mutual funds, so pension funds for example, and it is the highest ever. So that means that people are basically all in the markets. This is no problem until the market is getting into trouble. So as long as the market is stable and is rising further, that is good for the people and their net worth. But as soon as the market is dropping, and you can see here we got data back till 1951, and at those high levels we always saw some kind of a correction. It is just a matter of time. Here you can see a chart from Fundstrat, so an analyst house in the US, who is very bullish on the S&P 500. Later on, we are also going to discuss a few setups on the charts of the S&P 500, but basically they are saying if we break further to the upside, we could see a rise till 4,300 points. Please keep in mind there are analysts who are very bullish and are very bearish. In the end of the day, you should do your own research and prepare for both scenarios. That is something that we do as swing traders and total return investor and traders. We prepare for both scenarios so we can go either long or either short into the markets. Another thing we are going to talk about is the PPI, so the producer price index. You can see here we have some kind of inflation already. The PPI is up 2.8%, and the question is going to be if it's going to affect the CPI, so the consumer price index, because now the producers have to produce at a higher cost, and they have two options: they making losses, or they hire the consumer prices, so they balance out the losses they are making. In my opinion, from now on, I think they will wait a little bit till they hire the consumer prices, but sooner or later they will have to do it, because it hurts the company if the margin and their profits are getting lower. Here you can see a chart of the 10 years break evens. So break evens means the expected inflation in 10 years for the following 10 years. I know it sounds a little bit ridiculous and funny, but that's actually how markets work. You can see here we are at the highest point since 2014, and that shows the expected inflation in the market is really, really high. Here you can see we've had the biggest weekly drop ever in primary dealer holdings of treasuries. This happened because the SLR program that the Fed set up at the beginning of the Corona crisis is ending soon. What is the SLR program? I'm going to explain it to you in a trivial way. That basically means that primary dealers like big banks don't have to balance the bonds they are buying, so it doesn't affect their equity capital. But now, as the program is ending, they sold their bonds they've had in their portfolios, so they don't have to balance their bonds and don't get trouble with their equity capital. And the last thing we are going to talk about before we are going to look at some technicals on the charts is there is going to be a new ETF that's called the FOMO ETF. For me, that is an ETF I'm definitely going to short in the future if I find the right entry and if the market allows me a good entry. But it's funny to see that things like a FOMO ETF launch. And now let's take a look at some technicals on the chart. So here you can see the Nasdaq. First of all, I wanted to congratulate everyone who took the short trade we discussed in a previous video. We got here the breakthrough, got the retest, and then we broke through here. I also took it, so congratulations to everyone who took it, and also me. And yeah, so what is going to happen next? We saw a quite strong recovery as the stimulus bill passed. So this here now works as a support area, and also we broke through it, so also this here works as a support area. I'm only going to short the market again if we break through this support area here with a lot of volume, and then I'm again going to take profits here in that area. We also could see here an inverse head and shoulders pattern if we get up here, and I'm going to enter a long position if we break through here with volume, make a retest, and also break through to the upside with even more volume. Then I'm going to enter a long position here at that target. My first take profit target will be here. After that I'm going to close the trade, except we break through with a lot of volume. And if we break through here, I'm going to wait for a retest, and then I'm going to enter another long position with and take profit target at the upper end of the channel. But it also depends on if we get with even more volume through that channel, then I'm going to let it run even further to the upside. Next on, you can see here the chart of the S&P 500. We've broke out of this consolidation after we've had a bearish drop to the downside, and now it's going to be interesting if we are going to see here a break through this resistance area. We've wigged through it a little bit, so we've made a new all-time high in the S&P, but I want to see a breakthrough with a volume and a retest, and then I'm going to take the trade to the upside, and my take profit target will not be like Fundstrat said at 4,300. It will be at around 4,200 or 4,250, but I'm going to have a first take profit target where I'm going to take a little bit out of the position at the upper end of the channel, because there is a chance that we see a bounce back here to the downside. And next on, we are looking at the Dow Jones. The Dow Jones looks by far the most bullish of all the US indices. You can see here we broke out of this resistance area where we once tried it but failed it, so it was a fake out, but now we've got a confirmation, and this is a confirmed breakout. I didn't took the trade, I've missed it, sad but true. And for now on, it went a little bit too hot for me. I'm going to wait till I see another pattern evolving and then maybe take a trade there, because for me the Dow Jones is a very interesting market because of the high yields. Value stocks are very interesting to look at. Also in a future video I'm going to show you my new long-term positions into value stocks I've chosen that I really like. But for now on, I think some value stocks are very overbought, so I'm going to wait till I find in some value stocks a better entry position. But please keep in mind, this was no financial advice and only for educational purpose. Please always do your research. Trading and investing is risky, also keep that in mind. And with that all said, thanks for watching. Please smash up the like button if you liked the video, and if you like the content, please subscribe to the channel. And I hope I see you next time. Good luck with your trading, good luck with your investing, and please don't get wrecked, people.